Suppose you want to trade an asset because your fundamental analysis suggests that the asset is due to experience a dramatic price change. So you need to figure out the best time to instigate your position. Ideally, your market timing should adhere to these two criteria. Number one, the market has recently been in a trend that supports your analysis. This will improve the probability of success for your trade idea. And number two, the market is range bound, i.e. no volatility. This will improve the reward to risk ratio of your trade idea. So, how do we know when a market is either trending to the upside or downside or range bound? Well, we can use 3 different techniques. Technique 1, study the extremes. To use this technique, pick an appropriate time frame for your price action analysis. For instance, you could use a price chart for the previous 4 years, 1 year, 3 months, 1 month, etc. Most of the time, you should start your analysis with a weekly price chart for the previous year, i.e. 52 weeks. Suppose our 52-week price chart looks like this. Now, make a note of the market high and market low. And make a note of the dates of the market high and market low. If the date of the market high is more recent than the date of the market low, then the market is in a potential uptrend. If the date of the market low is more recent than the date of the market high, then the market is in a potential downtrend. Let us now examine the age of the most recent price extreme. If this age is less than or equal to 4 weeks and the market is in a potential uptrend, then the market is in a definite uptrend. If this age is less than or equal to 4 weeks and the market is in a potential downtrend, then the market is in a definite downtrend. If the age is greater than 4 weeks, then the market is range bound. Technique 2, use moving averages. Let this black line represent the closing price of our asset on a weekly chart with 52 weeks of data. Let this red line represent the 13-period simple moving average. And let this green line represent the 52-period simple moving average. If the black line is above the red line and the red line is above the green line, then the market is in an uptrend. If the red line is above the black line and the black line is above the green line, then the market is either in a bearish retracement or trend reversal. If the black line is below the red line and the red line is below the green line, then the market is in a downtrend. If the red line is below the black line and the black line is below the green line, then the market is either in a bullish retracement or trend reversal. If the green line is in between the black line and red line, either like this or like this, then the market is range bound. Technique 3. Use the 10-week simple moving average. This technique is outlined on page 62 and 81 of Larry Williams' book, How I Made $1 Million Last Year Trading Commodities. I will leave down below an Amazon link for the book in question. Basically, this technique involves looking at the slope of the 10-week simple moving average. If the slope is pointing upwards, then the market is in an uptrend. If the slope is pointing downwards, then the market is in a downtrend. If the slope is relatively flat, then the market is range bound. However, it is important to remember that this technique is about identifying the current phase of the market. It is not a market timing tool. So when the market goes either above or below the 10-week simple moving average, just ignore it. If you have any questions, then please either send me an email or leave a comment down below. Thank you for your time and happy trading.